Hello, everyone, and welcome to another episode of the Forever Cash Life Real Estate Podcast, where we talk about all things cash flow. Today, we're going to talk about multifamily, about how to find them, how to raise money for them, how to structure them, what criteria you're looking for. Our expert has over 3,400 units. So stay tuned, and we'll get going in just a second.
Welcome to the Forever Cash Life Real Estate Investing Podcast with your hosts, Jack and Michelle Bosch. Together, let's uncover the secrets to building true wealth through real estate and living a purpose-driven life.
All right, so here we are. I'm super excited to have my good buddy, Tim Bratz, here on the show with us. Tim, how are you doing?
Doing awesome, Jack. Appreciate you having me, buddy. Thanks for all the content and the value you provide, man. I'm excited to be on the show.
Wonderful. Thank you for being here. So first of all, to everyone watching, Tim and I, we know each other for a few years, I think, right?
Yeah.
And Tim really came out of the gates once he figured out this real estate stuff, like really, really strong. And in how many years have you built 3,400 units?
I built my current portfolio over the past 4.5 years. But
4.5 years.
But I will say that, I've been in real estate for investing for about 12 years, and I was doing some commercial, or not commercial, but brokering some stuff and worked for a big home builder and stuff before. So I've been in real estate a long time, built up a small portfolio, about 150 units, had to liquidate it through some business partners about 4.5 years ago, built my current portfolio over the past 4.5 years.
All right. So what made you, let's jump right into that. So perhaps you can give us a little bit of your history, but then leading up to that point where you said, okay, I'm going to just go big now. What triggered that point?
I think we all get in real estate for that allure of residual income and passive income, right? And that was me too. When I was going through school, everybody's making money in real estate, and that was 03 to 07. I graduated from college. I get a job in real estate, and market tanks. And I was like, what everybody's like, run from real estate. I was like, hey, I just showed up to the party, where's everybody going? And so I always loved the idea of having assets that kicked off residual income, that mailbox money that we all talk about, right? The issue for me is I didn't know that there was private money out there. I didn't know how you could structure these. I didn't know that you could, partner up with a loan sponsor and do all these different things. So I did it the slow way, right? I got involved in real estate, and I started doing the transactional stuff and flipping houses and wholesaling houses and doing the turnkey. And then I built up a management company. I was doing all those different things because I thought I had to stockpile my own cash in order to go out and get involved in these deals. Eventually, I met some people with some money and some private lenders, and we structured some deals and projects and started, developing a little bit of a portfolio. And some of those, I created an exclusive relationship with two guys specifically, and that partnership just didn't end up panning out the way we wanted to. We had to liquidate everything, and I went back. I had a couple of bucks, but I went back to the transactional stuff, right? And I started flipping houses again, doing all these things. And I remember about 2.5 years ago, I was investing in some apartment buildings and raising some money and joint venturing with some people who were great operators on the apartment side, and started buying some of my own stuff again. But I only had maybe a couple hundred units at the time, about 2.5 years ago. And 300 units, let's say 350. And at the time, I remember going on vacation. I sat back. When you're on vacation, you're just kind of reflecting on life and you're thinking about different things. And I remember waking up early in the morning. I was overlooking this lake in upstate New York, and looking at my goals and looking at my net worth and just kind of adding some of these things up, and realized that 90% of my net worth came from my apartments, but it was only 10% of my time. And I thought, man, what if I dedicated all my resources, my team and everything, to just focusing only on apartments and building wealth instead of just building an income, right? And I realized that middle income and low income people focus on income and how much you're making on an annual basis. And the elite, the highest, the most wealthiest people in the country focus on net worth, right? And what their balance sheet looks like. And so I thought, what if I just focused on balance sheet? What if I just focused on building my net worth and buying apartment buildings? And that's what I ended up doing. I came back from that vacation and just kind of burned the ships. And I said, hey guys, we're not buying houses. We're only buying apartments. And it's pretty amazing what happens with when you draw a line in the sand and you make that declaration to the universe, right? And how the universe then responds. Because then we started seeing apartment buildings, an 11 unit, an 18 unit, a 20 unit, and all of a sudden we started buying up these apartment buildings. Some of them we flipped because it was just didn't meet our buying criteria. It was too much of a C-class kind of an area. We kept the better stuff, the bigger stuff, wholesaled off some of the smaller things or the things that needed too much work, and then really just kind of put it out there, started educating people that and telling people all the time that we're only buying apartments. We're buying apartments. We're buying apartments. And just by putting it out there, I'm not the biggest owner of apartment buildings in Ohio, right? But I'm probably the best known because I tell so many people and everybody knows me as the apartment guy. So I get deal flow that nobody else gets. And that has allowed me to really create this machine where we're looking at 400 apartment buildings a month in order to buy one or two of those. And
so wait. So 400. I know a lot of people. I know we look at a lot of deals a month in order to get one, and we're closing on one right now. But you're looking at 400. When you say 400, you mean 400 times you get financials, you plug them into your system, you plug into your thing, you run them, or you just look at them as like you discard half of them right away? How's your process on that work?
Yeah, so my process, I know what my metrics are, right? And I know what kind of properties I want. And so every deal we
Which ones are you looking for? What are your metrics?
So my buying criteria, everybody's like, oh, real estate's my niche, right? No, real estate's an industry. It's not a niche. You're like, my niche is A and B class area apartment buildings that are value add, meaning they're physically distressed or managerially distressed. In landlord friendly states that are 100 units or bigger. That's my pocket. That's what I buy. And so we come across a lot of other things and we make offers on everything. Now, making offers, are we actually, writing out a 20-page offer? No. Are we even doing an LOI? No. But we're sending an email or at least having a conversation saying, hey, is it worth, you're asking $8 million. We'd be closer to 5.5. Is it even worth continuing the conversation? And that to me is still kind of at least swinging the bat to make an offer, right? Let's at least feel it out because they're like, hey, I know the seller's motivated. I know, well, this thing's been on the market for 12 months and we'll look at anything. We'll take a deeper look at it. And then we start looking at the metrics. So then, we care about what the stabilized value is, right? I don't care about, I mean, to an extent, I'm not going to pay a seller for the value I'm going to bring to that property, right? The value I'm going to add. So I do care about the current value, but I care more about what the after repair value is. I come from the residential realm where it's not about what the house is worth today. It's about what it's going to be worth once it's fixed up and renovated and you put it back on the market, right? So my entire model is to buy a distressed asset, force appreciation. I don't speculate on appreciation. I force it by doing the value add improvements. And my model is very similar to when I flipped houses. I have to be all in for 65 cents of the after repair value. So on a $10 million building, I'm all in for $6.5 million at most. Purchase price, renovation cost, holding cost. That allows me to then go back to the bank. Once we force the appreciation, that can all happen within 12 to 18 months. Once we force the appreciation, we go back to the bank and we refinance out with a 70% loan to value loan. So that allows us to then pay off our investors, pay off our short-term loan, and put long-term agency debt, which is non-recourse, fixed interest rate, long amortization schedules, and that's our business model. So when we're looking at all these different deals, we know what our numbers need to look like pretty quickly, and we can run numbers kind of in our head. I can analyze a deal in 2 minutes, in a snapshot, and that allows us to comb through 20 deals a day for the most part.
Okay. All right. That makes perfect sense. So, and then do you have a little formula for that, for running them in 2 days, in 2 minutes? Like you look at what can you share those formulas?
That's the secret sauce, right?
That's the secret sauce.
Yeah. Cause how many people do you see out there with these extravagant calculators and they're selling them for $400 and they're like, you need this in order to underwrite the deal. It's not the case. Like I have a commercial mortgage broker that brokers all my loans that's going to be taking these deals to the banks to go and get an 80% loan on, it's $5 million, $6 million bucks. That bank is going to underwrite it. The mortgage broker is going to underwrite it. So I lean heavily on them. I use a pretty quick formula to see if it's even worth pursuing. And essentially I just take whatever the stabilized rents are, and I multiply it out by the unit mix, right? So if the one bedrooms are worth $600 a month, or will rent for $600 a month once stabilized,
Sure.
the two bedrooms rent for $800 a month. There's 50 of each. Then I know it's $70,000 a month in gross rents. $840,000 a year in gross potential rental income. And then I know what my expense ratio is. So that's going to change and vary depending on wherever people are investing. But most of my areas, it's about 40% expense ratio on most of my apartment buildings. So I just use 50%. I use 50% because it's easy. So I just take whatever the gross potential rents are, I divide by 2. That puts me at $420,000 in net income, just a snapshot, right? And if they're asking, and I want to be all in for a 10% cap rate is essentially my number. And so I can pay $4.2 million all in on that deal.
All right. So you're buying at 10 caps off actual space, you're buying at. So I followed you all the way to the 10 cap. Is the 10 cap basically you calculate what this thing is going to be worth, stabilized.
Yep.
So you're basically saying once I have this thing running, I want it to produce a 10% cap, basically a 10% return
at my cost basis. Correct.
Cap. So therefore, I'm willing to pay today $4.2 million for that property because I'll know. If I pay this today, what that is that should include capex then already.
Yes. So then I deduct out the capital expenses.
So 4.2 is all in. So
Correct.
All in meaning including closing costs, including everything, including capex and so on. And that's what you're paying for this thing. So therefore,
Correct.
If you're basically saying let's say if I need to put in $500,000 in this property and I have $200,000 in closing costs, let's say, then I basically can offer $3.5 million on this property.
Exactly.
Okay, very cool. And that's how you go in, approach them. And if they're saying you're crazy, we have offers for 6, then you're okay, then you move on to the next deal.
Moving on.
All right.
I will not force a deal. I try to kill every single deal.
No,
if I can't kill it, then I know it's a good deal.
Very, very sure. It makes perfect sense. Very nice, very nice. So, which actually, if I'm thinking about the deal that we're doing right now, I went about it the more complicated way with a big analyzer and stuff like that. But we're just closing on a deal right now that we were estimating that the NOI once it's stabilized is going to be about $620,000. So basically, you would pay $6.2 million for it. Well, the good news is we're buying it for $5.3 and putting in about $800,000 in capex plus closing costs. We're right there.
Yeah.
So yay! Well, our deal would qualify for you.
There you go. And you did it in 30 seconds versus 3 hours, right?
Right.
Plugging in all that stuff.
Totally makes sense. So good. So this is gold, guys. So if you listen to this, take that down, rewind, watch it, listen to it again, watch it again if you watch it on YouTube. Very, very cool. So A and B class areas, so you're buying C class properties in A and B class areas?
Yes. So I'm buying or I'm building, right? So we develop down in South Carolina and Georgia. So we do some building and stuff down there, but we're buying C and D class and some B class kind of properties in A and B areas, right? A lot of people just grade it and they put this blanket grade on the property. Is that the property or is that the area? We want good areas, good school systems, safe locations, good economic anchors, but I don't care what the building looks like. I want the ugliest house on the best block, right? I want the ugliest building, the worst building in the best area. That's what I'm looking for because that's where you can create the most appreciation.
So it's fascinating. You're really taking the single family model of the fix and flippers and translating it to the multifamily, and it's working quite well because you bought over, I think, was it $260 million worth of real estate in the last 5-6 years or 4.5-5 years.
Yep.
So let's jump into that part. So $260 million worth of real estate. Of course, that's the after repair value right now, the stabilized value. Perhaps when you purchase it, you probably paid less for that. But
I have about I think I'm at 200. I just closed on another deal, so I'm at about $270 million of portfolio value, and my total cost basis on that is I think it's like one. With debt and equity, It's about 160 million, 165 million.
So you created $100 million worth of extra equity on those deals. So now, when you go into these, go into these deals, how do you structure them with your investors typically?
Yeah, so there's a broad spectrum, right? There's traditional syndication, where a lot of people are going out, and this is what most people do. They go out and they give their investors 75% ownership in the LLC. So that means they have 75% owner of the cash flow that comes in, and all these different things, right? And the operators only have 25%. I don't do it that way. I don't think, to me, it's just not congruent. You're not in the same boat rowing in the same direction. And Jack, I've never been to a course. I've never been to a class. I never read a book on this stuff. I just kind of took it and took what made common sense to me and kind of broke it down, and it made a lot of sense to my investors too. And that's, how I teach people how I do it now. Right. So for me, I just like the idea of, you take a look at any given deal. Like right now, it's way harder to find deals and to operate those deals because they're usually more distressed deals. So the work is usually worth more than the money today, right? It's very easy to find money. But remember 5, 6, 7 years ago when it was money was nowhere for real estate, but deals were everywhere. So if you said over the course of time, right, that the deal is worth 50%, the work, and then the money is worth 50%, that's kind of how I aligned it in my brain.
We're doing the same way.
So I took the money. So what parts are included in the money? It's who's sponsoring the loan. Essentially, they're getting 80% of the money, right? Who's putting up the actual cash? That's real risk on the cash, right? Who's raising the money? Who's doing the capital management and all the securities kind of stuff? That's all on the money side for me. And then there's the operation side. Who found the deal and did the due diligence? Who's going to be project manager? Who's doing the asset management? Who's doing property management? Who's doing like all those different things? Who's going to be boots on the ground over the course of not only while the property's being stabilized, excuse me, not only while the property's being stabilized, but for the next 10 years that we own it, right? 15 years, 30 years that we own it. Like somebody has to be, and it's very difficult to say, hey, finding the deal is worth this much, because that's a 90-day thing versus somebody who's going to be boots on the ground for the next 15 years, right? So trying to balance all that stuff out. But yeah, typically what we do is our equity investors get a preferred rate of return on the money, right, regardless of the property's performance. So we're paying them out of like an interest reserve if it's not performing. But it's very predictable for us because we know when the property's going to turn around, right? We know that we can turn this thing around in 6 months or 9 months or 12 months. So we can project out what kind of interest reserve we need. And then we know we can stabilize it and refinance it within that 12 to 18 month time frame, let's say. So it's very predictable for us. It's not like we're forecasting out. And because we can turn over the investor's money in a shorter amount of time, it allows us to give more velocity on their money. So now I can give them 25%, let's say, in one of my deals, 20, 25% equity. They get a fixed return that's very predictable for them. So they made a good double-digit return while the money was invested. Then they get all their money back. Then they keep 20% ownership in perpetuity. Now, why would you ever invest in that deal when you can go over here and get 75% ownership in a traditional syndication? Well, one, in a traditional syndication, your money's out there for 5 years, right? In one of my deals, there's velocity on it. I can roll it over 3, maybe even 4 times in that same 5-year period. They can have a predictable return on their investment, have all their money back, and still own 4 assets, right? In a traditional syndication, their money's invested for 5 years. They're only being paid if the property's cash flowing. So if it's not cash flowing for 3 years, they're making 0 return. And a lot of times, the exit strategy on traditional syndication is selling the asset. So they're just stuck with a high-paying job, you know?
Right. And a lot of times people get hung up on the equity part of it, but the equity that they own doesn't really mean anything, because what's defined, it's all defined in the operating agreement anyway, in the PPM. So if it doesn't matter if they own 10% or 90% of the property, if at the end of the day, the way the money is being distributed is in a certain way, then they might not get 90% of the profits at the end of the day. They might only get a certain percent of the profits. So it's important.
There's these waterfalls, there's all sorts of fees, there's all sorts of other stuff that are done in traditional syndication. We don't do asset management fees. We don't do capital events fees. We don't do fundraising fees. We don't do any of that stuff. Very rarely do I even take an acquisition fee. Just depends on what's going on with the my team and the overhead and stuff that we have on our company, right?
So yeah, so it's very similar to us when we basically, it's like we do a 50-50 with the investors, but then it's like the pref, we don't charge an acquisition fee and things like that. Yeah. Because I agree, well, we do charge an acquisition fee, but we don't charge an asset management fee. But that's the only fee we charge, the acquisition fee, because
same with us.
No, it's a shitload of work to find them. Sorry, my language here, but
it's a lot.
It's a lot of work. Finding
there's money, there's time, there's salaries, there's all these different things that we're spending that they're not seeing, right? They're just seeing the deal and they think it just came out of thin air. And the other thing, Jack, is like you guys are buying at a wholesale price, right? Like that building that you're all into for $6.2 million is going to be worth $10 million, right? When it's all stabilized. So coming in and getting 20 or 30% of equity in that deal is worth more than buying a $10 million building for $10 million and owning 75% of it. Doesn't mean anything, right? Like that's not worth anything. You have to wait and speculate for appreciation. And I just don't believe in that. I believe in creating appreciation as a true real estate investor.
Right, wonderful. Awesome. So now let's talk about finding the money. Now, I know you accelerated quite a bit. Like you went from doing a couple of deals at the beginning to you're shooting on all cylinders and running on all cylinders. Where do you find investors? Because somebody's looking at that saying like, well, this is great, Jack. I make my money land flipping or whatever it is. I want to get into this part at some point of time. Where do people find the money?
Everywhere. There is $2.1 trillion sitting on the sidelines right now, waiting to be invested into alternative assets and fixed assets like real estate.
So I expected kind of that answer, but I want to dig a little deeper. And my question is, do you work like there's kind of there's this two worlds out there. One, and I think a lot of beginning investors in my audience is a lot of people that are just like working into real estate, trying to figure things out. If they're or they're doing our land flipping already, if they want to get into this, there's like this perception that you either go and you have to syndicate and you have to ask, like chase down, like almost like multi-level marketing level, kind of like knock on doors and ask people to invest with you and things like that. Or there's the perception that you have to go with these big family offices that are hard to get into, but then they want like 80% of the money or 80% of the deal. Yep. What has your experience been? Where, like, do you work with institutional investors or do you work with just friends and family in a sense, or people that come to you, people that you find, that people that just refer each other and more like on a groundswell, which of course nothing to do with network marketing?
Yeah, I do not. I've never used institutional money for anything on the equity side, right? I think they're greedy pigs, and I'm disgusted by them, right? So they come to me, somebody with experience, right? They want 85% ownership in the deal. And I'm like, are you out of your mind? Do you have any idea how hard it is to find and operate and manage and like dedicate years of my life to a single deal? Like, no chance. So it's not congruent and doesn't sit well with me.
And I agree 100% with you on that. We haven't done that either. Neither do we have any intentions to do it.
But I work with entrepreneurs. Entrepreneurs are the best people to work with to raise money from. So there's two schools of thought on anything really. There's the hunting and then there's the fishing technique, right? You hunt, what happens to the prey? Usually they run away from you, right? So when you go out there and you're banging on people's, and you're like, no, you need to lend me money. First of all, nobody likes to lend money. It just it's not a good feeling. The sound of it just sounds like I'm going to get screwed, right? I'm not going to get paid back. But everybody loves to partner up or joint venture. So I always take that approach, right? And raising money is one of those things where like it's a big deal in our heads. So then we make it a big deal when we're talking to investors, and then it's a big deal to the investor too. If you make it not a big deal, then all of a sudden it's like, hey, you want in on this? You want to partner up? You want a JV? You want to throw in some money and I'll do the work and we'll figure out a way to make it work. And you make it not a big deal. It ends up not being a big deal. It makes it a lot easier for people to then invest with you. So for me, I'm always educating people on what I'm doing. I think education is the best sales process out there. Exactly what you do, right? You're telling people how to go out and flip land, how to go out and buy apartments, how to go out and buy commercial. And from that, naturally people are going to say, Jack, man, I love what you're doing. I want to buy deals and I want to flip deals and I want to do some of that stuff too, right? Will you bring money to my deals, right? And then there's going to be other people who say, Jack, I love what you're doing. I don't want to do any of the work. I want nothing to do with that. You go out and do it. You go be the workhorse, but I have money or I have access to money. Let me go and invest it in one of your projects. And that's the kind of people that I like to work with. I like finding entrepreneurs who are out there like just banging it out on their own business and crushing it and launching products and selling their company and building a new company and doing all. They're too busy to come in and bitch and complain and ask me too many questions about what's going on. Like, let me go do what I'm good at. You go do what you're good at, and you're going to get your money every quarter that we make distributions, right? And they love it. So entrepreneurs are the best, who are not in real estate, are the best people to raise money from. I also love people who buy turnkey single family because they think it's this predictable return on investment. They think that it's absolutely not, right? We all know
no,
that.
it's not. Yes, yeah.
Who's been in it. And then they learn that after they buy their first one. And they're like, I'm going to make $700 a month, seven. And then all of a sudden they make $2. And then all of a sudden the tenant moves out and they got to spend $5,000 or $10,000. And it's like, I want the equity upside, but I also want a predictable
like
return.
20 plus doors, because then it starts averaging itself out. But but if you spend 20 plus doors, you invested $400,000, right? And you might as well invest the $400,000 into something where you are passive. Then you get a almost guaranteed return. And we do the same thing. Our investors, they get paid whether the property makes money or not. And so you get that, plus you get a piece you get cashed out or a piece of the back end, and it just makes total sense. So I'm glad to hear that.
There's a lot of money out there
that and I want to make the point that you don't have to know the people that have like the billions of dollars. You can partner up with somebody at the beginning, perhaps, that has already those relationships. You bring the deal, they bring the money, and now you give them a piece of the deal because you got to pay you got to earn your way into. So like the very first deal that we bought is a deal that we knew we probably paid a little bit more than we should have. It was still a good deal, but we knew that we're not going to make money on that deal for the first year and a half, because the investors are going to get all the money. But we did that because it enabled us to get in with Freddie Mac, right? So it was worth more to get a Freddie Mac loan than it was to make money for the first year. So we're paying our dues too. So we've been working on this deal for a year and a half for free, basically, not making any money on it. But now finally it is where it needs to be. It's stabilized. Everything is done. Everything is turned around. All these things are done. Now we're starting to make money on, but we're willing to do that. And so when you find deals in real estate, you want to do that too, right? If you don't have the relationships you had already some lender relationships and private money relationships through your fix and flips. But if somebody comes and hasn't done that yet, then go find the deal. And if the deal is good and follows those pieces, the money is going to be everywhere. And even if they have to give half of the deal or a percentage of the deal to somebody with the experience and the access to the money, because after that deal, you have the access to the money, you have the experience, and everyone takes you serious. And that's the thing. Now, after having 2 deals in Oklahoma City, we're getting deals. We get every deal in Oklahoma City that comes on the market comes to us, right? Because we now are players in the market, right? And it's the same for you. You in Ohio, everyone knows you, that you're the apartment guy. So love that.
And to your point, I gave away 70% of the first 250 deals that I did. 70%, because I knew exactly what you said, Jack. I needed to build the resume, right? You needed to get the experience under your belt, because then you can go out and then you can own 70% yourself of all these other deals, when you're getting into bigger stuff. But you got to pay your dues. Everybody wants 100% of the equity, and everybody wants, the moon and everything with it. And they're not like, they have zero experience. Like, it's like you get compensated for the value you add, not for the value you are, right? So you got to go out and find the deal. And if you don't have money, go out and find a deal that's a massive value that you're bringing to the table for anybody like Jack or me or anybody else in your local market that you can bring that project to. Then you joint venture, be willing to do the work, be willing to shovel dog shit if you have to, right? If you're willing to do that kind of stuff, then people want to work with you.
Absolutely. With that said, I have 2 extra points, and that is, like you mentioned that you could talk about off-market deals. How do you find off-market deals? That's like the holy grail. Everyone wants to find them. So how do you do it?
Same way. This is not an exciting answer, but it's the way that I find them is the same way that I found deals on the single family side. Just like single family owners of property have phone numbers and email addresses and mailing addresses. So do owners of multifamily apartments and commercial real estate, right? So you can do direct mail. You can do outbound phone calls. Instead of calling for sale by owners, you call for rent by owners. I'm not interested in renting. I'm interested in buying your whole apartment building. Do you have any interest in selling, right? You can do drive for dollars. Just like there's houses with tall grass and boarded up windows. There's buildings with tall grass and boarded up windows, right? Go down to the building department. Like, they'll tell you who has violations on their properties. And if the city's on their tail about it, guess what? You can reach out to them and say, hey, notice there's a bunch of violations on your property. I don't know if you have the money or not. I'd be willing to come in, take it off your hands, take the problem off your hands, blah, blah, blah. See how that conversation goes. Build relationships with people who are in the commercial real estate realm, real estate attorneys, property management companies, vendors like contractors, landscapers, exterminators, coin-operated laundry service providers. Like, there's a lot of people in that whole industry that are coming across, and they know all the different owners. And so if you just go out there and you start building those relationships, social media, one of the big ways that I found I get a lot of deal flows through social media. Every time I post something about an apartment building, people hit me up on private messenger, and they say, hey, I want to buy a deal from you, sell a deal to you, joint venture with you, lend you money, or will you coach me? Will you mentor me? Happens all the time. Podcasts, local meetup groups, local entrepreneurial groups, real estate investors associations, landlord associations. Are you plugging into all those different things? And eventually you do a little bit of all those things, or you figure out which ones work the best for you, and you gain a little bit of momentum. And then all of a sudden you start buying properties in a certain town, like you are, Jack, or like I am down in South Carolina and Georgia. And then you become one of the top 10, 20 people in town who buy deals there, and you get all those off-market deals from the brokers then. But right. You got to build up a reputation, right? You got to find some stuff off market first. You're not going to get good deals from brokers if you've never worked with them before.
Absolutely. Yeah. I just had a conversation with a broker last week because we want to finally buy in our home market in Phoenix but Phoenix prices are off the charts. So it's like, it was a funny conversation with a broker because I basically told him, listen, I understand just because you have a call like this probably 5 times a week with a new investor wanting to come to town and wanting to do something. I don't expect you to be like jubileeing and sending me your best deals like tomorrow and drop off all your experienced customers that buy every deal that you have here. So all I want is to just basically for you to pick up my call when I call you over the next few weeks, once a week. And he's like, okay. So what I'm going to do is I'm going to call the guy once a week for the next 3 months if I have to. And I bet you by month 2, he's like, okay, this guy either is not going to leave me alone until I send him a good deal, or he might be real, right? And at that point, he then sends you some deals.
Love it.
There's all these people that just call once, and then they're like, expect to get the best deals, which is just not going to happen. So we had a good laugh about him understanding that I understand his position, which goes a long way to make sure that to separate yourself from the crowds. Right.
Well, and understand this, like understand the psychology of a broker. Does a broker want to co-broke a property? Right? No. So they already know who the top 10 buyers are in town. And when they get a listing, they're going to take it and market it off market and just directly phone call those top 10 buyers. If those top 10 buyers, if they like the deal, one of them's going to buy it, right? Right. If all of them say no, that's when it hits LoopNet. That's when it hits the MLS. That's when they're going to send it to some newbie investor to see if you're enough of a putz to come in and buy this thing that everybody else said no to, right? So if you see a deal that actually hits the market, chances are it's not a good deal, right? Because the top buyers in town already all said no to it. So that's why you got to be off market. That's why you got to, but it's hard to build those relationships like you're saying until you actually have some reputation for buying apartment buildings in the area.
Right. Exactly right. So it's kind of like the cat is like this vicious cycle that unless you have the experience, you don't get it. But that's where the other methods come in. Okay, exactly. So then how do you see the market right now? I mean, obviously, we have been on a 10-year expansionary period right now. Every year, the industry is like, well, it can't continue on. What do you say to that? What do you say to that, and what do you see the market?
Like we said earlier, there's $2.1 trillion on the sideline waiting to go into alternative assets. What that tells me is that people don't want to invest in the stock market. So I think the stock market could could waver. I think the stock market wavering actually makes it stronger for us who are in fixed assets like apartment buildings and commercial real estate, right? So I think more money is going to come out of the stock market and be on the sidelines waiting to be put into apartment buildings and commercial real estate. And if the market, even if the market shifts though a little bit, let's say prices come down by 10%, a bunch of that money is going to come off the sidelines and start investing because they think they're going to be buying at a discount now. So what does that do when a bunch of money then gets infused back into an industry? The prices go back up. So I really don't see housing prices, at least in commercial, in apartment buildings, fluctuating too much in the next 12, 18, 24 months. Okay. Now you're talking about other commercial asset classes like self-storage. Self-storage is being so overdeveloped. And I own some self-storage, but in a lot of areas it's being overdeveloped and it's cannibalizing its own industry, right? So now all of a sudden occupancy is dropping across all self-storage in several markets. I mean, you take a look at retail space. Amazon, the largest business in the entire world, made their business by taking business out of retail, right? And taking it online. So what is that going to do to retail space? Now there'll always be restaurants and barbershops and stuff like that, but I mean, brick and mortar retail, people selling widgets. I mean, what's that going to do? I think a lot of retail space is going to go vacant. What's that then going to do to office? Maybe office moves out of office and then they move into retail because they can get the same price per square foot, but maybe have some foot traffic or have a little bit more vision.
Or funnel
people seeing their business.
Retail is not stuffed off in an office park, but it's right next to some restaurants.
Exactly. And even warehouse is cheap and a lot of, I think retail is going to be going off and going into warehouse space. They still need someplace to store their stuff, even though they're doing online sales. But if all this office then goes vacant and all this retail goes vacant, then I don't know. I think it's going to be a weird, crazy cycle. I don't know enough about it. But just thinking about the different dynamics, if it's a home run deal and I can buy it for less than 50 cents on the dollar, then I'll buy in some of those asset classes because I know I'll be at a low enough basis where I can make it make sense. But otherwise, I just like apartments. I like apartments. A lot of my stuff is in South Carolina, Georgia, Florida, Texas, Oklahoma, Alabama, and North Carolina. So like I like the South, the Southeast a lot, and that's where a lot of the population's moving to. And I think as long as the population keeps growing, there's going to be a need for housing. And I think a lot of the houses are too expensive out there. A lot of people don't want to be committed to a house. And I think they're going to keep on renting apartments.
Wonderful. I couldn't have agreed with you any more. I see the world exactly the same way. That's why and the only asset class we invest in is, other than land, of course, is apartments. So we have one other commercial job, which is a car repair facility, but it's in a gentrifying area where everything around has already been rebuilt and we have the only ugly duckling place in there. But it's paying me a 24% return every year and cash return. So I'm not complaining. It's a great tenant in there. If and when he ever moves out, let's say 5-10 years down the road, this is an A area that has a C-class car repair shop in it. At that point of time, that thing is ready to be rebuilt and put something completely different on. But in the meantime, it's producing a tremendous cash flow. And so, but other than that, we don't invest in anything else like that. Wonderful. Great. So a couple of questions I have left, and that is number one is, are you a reader? If you are, what kind of books have you recently, one or two books that you recently read that made a bigger impact on you?
Man, I mean, I love all the classical personal development stuff. And I think a lot of the current things are a lot of that information kind of reiterated, regurgitated, recycled. But there's some really, really good books out there right now. Like one of them, it's actually not a new book, but a book that I'm reading right now, I read every year right around the holidays, is it's called 12 Pillars by Jim Rohn, R-O-H-N, one of the foremost thought leaders, personal development. It's where Tony Robbins got all his stuff and all these guys. And so Jim Rohn is has been a massive influence on me. I didn't even learn about him until about a month or two after he passed away. But his books and his readings and his philosophies have been extremely impactful for me. And 12 Pillars is a very easy read. It's like 100-page book, very small, and you can knock it out in 1 or 2 sittings. And it's packed with these profound principles on how to build a good life. So it's not just about making money or building wealth or buying apartments. It's not really about that at all. It's about just building a good life and the things that you should be spending some time on and really reflecting on. So 12 Pillars, really, really good book.
Awesome. And then I do want you to mention one of your principles of time management that you do that I actually adopted from you. That when you shared it, I was like, right there when you shared it, I was like, I went to my calendar and I blocked off a whole bunch of time, and you know what I'm talking about, right? Mm-hmm. Can you share that one with us and the reasoning behind it?
So I'll tell you the whole story. So about 2 years ago, my daughter was about 2.5 years old. Come home from work, and we're entrepreneurs, right? We're burning the candle at both ends. We're always grinding and trying to move the needle forward on business and all these things. And especially with technology, like on our hip with our phones and all this stuff, we're always checking emails and voicemails and text messages and all these things. And so one night I came home from work at the office. We had our family dinner, and we're sitting there and finish up dinner. And all of a sudden I look over and into my office, and I see the phone, like the little light blinking on my phone. Right. And it's like, I need to go get my fix. So I go over to the office, and I'm looking at my phone, and it's a text message from, I don't know, one of the guys. I don't even know who it was. I think it was one of the guys on my team. And I'm responding to the text message. My daughter comes over. This is after dinner, right? So it was about 6:30, right before she goes to bed. And she says, Daddy, and she's tugging on my shirt, says, Daddy, can we go play in the playroom? I said, yeah, baby. And meanwhile, I'm looking at my phone. I'm like, yeah, hang on one second. And she said, Daddy, you know how toddlers are. And they're like, they don't stop, right? And so she keeps on tugging on me. I'm like, baby, hang on one second. Let me finish this up. And why don't you go play, and I'll come and play with you in just a minute as soon as I'm done sending this, okay? She goes, oh, okay, Daddy. And she goes and plays in the playroom. And I finish sending the text message. And I look down at the text message, and I look at my daughter playing by herself in the playroom. And I look back at the text message and realize that it was not important and it was not urgent. And I'm thinking, I just, like what kind of dad am I, right? Like, my daughter came over here to play with me right before she goes to bed. I haven't seen her all day. And she's coming to me as the man in her life, being the guy that she comes to for support and love and encouragement and positivity and all these good things, right? And whether I know it or not, or whether she knows it or not, she's coming to me, and I keep on saying, go away, go away, go away. How many times do you say that until you start imprinting daddy's associated with disappointment and sadness and being ignored, right? And so it was a massive punch in the gut. I'm sitting there in my office looking at my daughter, and I'm just like, man, like, I need to get my shit together, right? And I'm thinking, like, what could this compound into? All of a sudden, if she associates me with those things, she starts dating guys who ignore her because she thinks that's what love is, right? Not that I would ever verbally abuse her or anything like that, but like, she deals with the other stuff that comes with being ignored and comes with not being cared for, because that's what she thinks love is, coming from the number one man in her life. Yeah, absolutely. So like, at that time, I was like, I need to do something different. And I remember looking at my calendar after she went to bed that night and thinking, like, I need to set some time aside for my family and for my daughter. And I'm like, all right, and I'm looking at my calendar, and all this time is blocked off on my calendar for meetings and appointments and phone calls and coffee and all these different things for business. And I'm like, why do I do that for business? But there's nothing time blocked on my calendar for my family, right? Like, what if I just started time blocking for my wife, for my kids? And that's what I ended up doing. I ended up time blocking every evening from 4:30 on to just be with family. And then I time blocked the weekends, and then I started scaling back, and then I started time blocking on Fridays also. And so we do Friday Family Fun Day every Friday. And so I don't answer emails. I don't answer text messages. I don't take phone calls. That's time blocked for my family. I don't do podcasts on those days. I don't do speaking engagements. I don't show up at RIA events. I don't do anything if it's in the evening or if it's on those weekends. And what it's done, because you're like, oh man, I'm going to give up on business. And that was enough of a punch in the gut where I was like, hey, I'm willing to do that because my family's more important. But what it's actually done, Jack, is made me more efficient in the 4 days a week, in that whatever 7-8 hour period, 4 days a week, that I'm actually in the office. So in 30 hours a week, I'm actually accomplishing more than when I was working 60 hours a week, because I don't do coffee anymore. Hey, if you want to hop on a phone call and pick my brain, let's hop on a 15-minute phone call, and make sure it makes sense. I've been so refined in my business that I figured out what are all the questions that everybody asks me and what are the biggest needs. And I funnel it to different A players on my team to make sure that they can handle it. I figured out what the highest and best return on my time is. And that's all I spend my time on in those 25, 30 hours a week that I work now. And listen, man, when I go home and my wife is at the grocery store with my daughter and my son's napping, do I hop on the phone or take a phone call or answer emails and answer? Absolutely I do, right? But if we're at the zoo, phone stays in the car, right? Or if we're doing Friday Family Fun Day and going to lunch or having dinner, and as soon as I get home, phone goes upstairs, so I'm not even tempted to go and answer it. And it's made a big impact with my family. It's made a big impact in my business as well. So time blocking is key, man.
It's a beautiful thing. And I've adopted that at 4:30 every day. It's off. And am I perfect at it? No, right? I'm not perfect at it, but it's helped tremendously. It's helped. My staff knows it's on there. Our team knows it's on there. They're not booking anything in there. Do I go over it sometimes? Yes, of course I do, but not always. Mm-hmm. And less than always, of course, much less than always. And also what we just integrated started at that we were still fighting a little bit over the time, or fine tuning the time, not fighting, is at a certain time during the day. Right now it's 7 p.m., but we're going to do it more, probably even phasing that a little earlier. All electronics are being put in on a central charging station, and nobody touches electronics anymore. We're then, for the rest of the evening, we're together as a family. There's still plenty of times. There's my daughter works in school on an iPad all day long. She has electronics plenty. Between 3:30 and when she comes home, or 3 and 6 or 7, there's plenty of time for electronics. Just after that time, it's family time, right? Mm-hmm. It's family time. She's 12. She's still going to be awake another 3 hours or so from that time on. So it's 3 hours that we just can hang out together, watch a movie, or play something, go something, talk about something, and it's just for the little time. We just implemented that because of she's hitting like that pre-puberty area of like where social media starts becoming really like a kind of a peer pressure kind of tool. It's even more important to kind of phase back and channel it in the right way. So love it. Thank you very much. Now, last question, of course, how can people find out more about what you do? I know you teach this now, you have seminars and things like that. You have obviously investment opportunities. So tell us how people can find out more about you.
Yeah, I appreciate that. I'm active on social media. Find me on Facebook. I'm very active on Facebook, Instagram, LinkedIn, YouTube, all that kind of stuff. And I do a little bit of coaching, nothing crazy, but I do 4 events a year called Commercial Empire. And so it's just it takes the complicated world of investing in apartments and commercial real estate, and that hey, I didn't come from money, and my great grandpa didn't own a bunch of commercial real estate. I didn't go to Wharton School of Business, and I don't have these initials behind my name because I'm not a commercial real estate agent, right? And we put these limitations on ourselves about what it takes to get into apartments, and the reality is it's all bogus, right? And all you got to do is you can simplify it to a 3rd grade level and go out and start buying apartment buildings right away. And so that's what we do. I truly believe that wealth is like sunshine, right? Like there's enough sunshine where you can have as much sunshine as you want, Jack. I can have as much. It doesn't take anything away from me, right? And I truly believe that the wealth is the same way, and there's a ubiquitous amount of it, and that's why we teach. And then all of a sudden it creates collaboration efforts, and I can bring money to students' deals. Students can bring money to my deals, and we're able to just do more deals together. And 1 + 1 = 10, right? So it's a pretty cool model and pretty cool business, and very fulfilling, feeds the soul kind of a thing too. So if you want to check that out, commercialempire.com, and then just friend me up on Facebook and say hello.
Wonderful. Well, with that, thank you very much. That was a very good session. Thanks a lot for being on the show. Loved your little secret sauce pieces of how to quickly analyze a deal, and many of the things that you said. So with that said, thank you very much for being on the show.
I appreciate you having me, Jack. It's awesome. And I love seeing you at all the different masterminds that we're a part of, and appreciate, again, all the value that you put out there, man. So thank you.
Yeah. Looking forward to seeing you in the next few weeks again in one of the masterminds. We think we belong to two that we're together, often sit next to each other and having a good time. All right. Thank you very much. With that concludes our latest show of the Forever Cash Live Real Estate Podcast. Thank you very much for tuning in, and I talk to you in the next episode. Bye-bye.
Enjoyed this episode? Then make sure you like, subscribe, and post your comments and questions below the video. We're looking forward to hearing from you.